In this lecture, we're going to begin to understand how to analyze a set of financial statements. The person doing the analysis is called an analyst. So the analyst is basically trying to get an understanding of whether or not the management is doing a good job or a bad job. But we're going to get a little bit more deeper in detail than just that. So as you recall, our example company is Mossico. Mossico sells truck accessories. They don't manufacture the accessories, they just sell them as a retailer or a wholesaler. So the balance sheet is a financial statement that's going to show the resources that management has, so the stuff they have to run the company. And then the income statement shows how well the managers are doing using the resources to run the company. And if you look down on the balance sheet a little bit further, you'll notice that we have the other side of the balance sheet, which shows the liabilities, meaning the loans and things that are like obligations that the company has, and the equity, meaning who's invested in the company. So this is the information that we have, and they call this these financial statements a window into the company, a window into the business, because you can't just go down to Mostico if you're interested in investing, or if they've asked you to lend them money and just look through all their books. You can't do that. So what you have to do instead is use the financial statements as the window into the business. So in order to do that, the analyst needs to first of all understand the accounting rules. In order to use the financial statements that were created with accounting rules, we must understand the rules. Second, the analyst must be able to read and understand the notes to the financial statements. The notes are additional information, not just the numbers. So as you recall, the financial data is turned into these financial reports, these financial statements. But in order to do that, they go through the set of rules called GAAP, or Generally Accepted Accounting Principles. Now, the thing about GAAP is that management has some discretion. What that means is they get to make some decisions about how things are done. So some of the things that management has discretion over include how estimates are done, how they do the timing of transactions, and how they apply the rules that are in GAAP. So these things can have an effect on how the financial reports look. And it turns out there is a conflict of interest in many cases. Right? So what that means is that management's interests do not always align up with the owners of the corporation, meaning the stockholders. The managers want to have financial statements that look good, so they might get bonuses or get promotions. And the financial statements are used by the investors and creditors to make decisions about what they want to do, whether they want to invest more money, pull their money out, lend them or not lend them additional funds. So they don't always coincide. So that conflict of interest is an important thing for you to remember. By understanding the management discretions, we are able to better get a feel for how legitimate we believe the financial statements are. Now, when we start to do our financial statement analysis, one of the things we can do is look at what they call a time series analysis, meaning how is a business changing over time. So in this case, I did 3 years, 2000, X1, X2, and X3, whatever 3 years in a series. Now, be careful, because sometimes the financial statements start with the most recent year and it goes backwards. But in this case, I'm just going to go ahead and put it X1, X2, and X3. So in a time series analysis, we're looking for a trend. What is increasing and what is decreasing? Now, if you can do this for a single company, you can also do it for a business unit. So like, for example, how one product is doing over another. Management sometimes does that. And then there's what they call a cross-section analysis. A cross-section analysis is comparisons with other companies or other business units. And when you do this, you're usually looking for what they call benchmarks. So benchmarks are something to compare to. So a benchmark is a predetermined standard, something that you would expect to see, and you want to compare whether the company is doing better than that benchmark or worse than that benchmark. So we have three key terms that we just went over: time series analysis, cross-section analysis, and benchmarks. Let's first delve into the time series analysis. So when we're talking about time series analysis, there's two very common ways we can approach this. One is a common size analysis, also known as a vertical analysis. Right? And in a common size or vertical analysis, we're looking at vertical, and vertical means up. So we'll be looking at comparing what's going on within a single column, usually the most recent year. So we'll look at 20x3. A trend analysis, or also known as a horizontal analysis, will look at what's going on over a series of time. So for 2 or 3 years, or even more, but typically 2 or 3 years, we look at how things are changing. How has the cash changed? How have the assets increased? How have the liabilities or equity increased or decreased? So for a vertical analysis, a common size analysis, where we will do everything on the balance sheet, everything over the total assets number. So everything over 24,300. Now notice this is in thousands, so that's in order to get the actual number you would multiply by 1,000, but we use a smaller number because it's a lot easier to work with it, and because it doesn't change our proportions. So 24,300 is a lot easier than put in 243,000,000, and so it's also a lot easier to see the ratios and proportions to each other when we knock off the last 3 zeros. And even bigger companies will do this in millions. Our business is not that big, so we just knocked off the last 3 zeros. So as you can see, the cash is 3% of the total assets. And you do the same for everything in that column. Remember, this is a vertical analysis going up and down. So everything over 24,300, 2,900, 2,400, 3,400, 800, every one of them. I didn't put every single number, but you just put any number that's on this column and you divide it by the same number, 24,300. And what this does is it gives us a percentage of our assets. Remember, our assets are our resources. So it helps us to see what our major resources are. Now, our business sells truck accessories out of warehouse and even has some retail locations. So you would expect the key elements of this business to be the inventory that it sells and the warehouses and the retail store space. So we actually do see that. We see that the biggest percentage of the assets is the retail store space and the warehouse, the net property, plant, and equipment. And then one of the other largest assets we have is our inventory. So that makes sense for this business. We continue down into the liabilities and equity, and the reason for that is because it helps us to see how we got our business. What is our biggest obligations, and how much of that obligation is it compared to the resources that we have? So we can see that our accounts payable are a pretty big chunk of our organization. 25% of our assets compared to, 25% of our accounts payable are 25% of our assets. So it's a pretty big chunk of assets that are being held as obligation by the accounts payable. So it gives a feel for where our risks are and where our business has its major exposure. And it also shows us, for the equity side, how much of the business is owned by the investors. Now for the income statement, we get the same thing, except we're putting everything over the total revenues, right? Over the net sales. So what this does is it tells us how big of a chunk of our sales are used up for expenses. So first of all, we can see how much our cost of goods sold are, so we can see what kind of markup we have on our parts. And so everything is going over the sales. So everything over net sales. So you can see the formula there, and you can see that everything is there, and we can see the biggest expenses. Our salaries are our biggest expense. We can see how much our gross profit is. We can see, what kind of income tax exposure we have. We can see all that stuff. And so that's the purpose of this, of doing this common size analysis for the income statement. And one of the benefits we get when we make this into a percentage instead of just looking at numbers is we would be able to compare our company to other companies that aren't the same size, and we can see what percentages those companies have tied up in their assets, their liabilities, their equity, how their income statement looks compared to ours, even though we're different sized companies. Percentages allow you to do that. Now, when we do a horizontal analysis called a trend analysis, we're going to put everything over the base year. So the earliest year is the base year. Right? So what we want to do is just go horizontally from left to right. And so we would put the cash, for example. The cash would be 1,000 over 1,000, or 100%. Right? That's what we have for 2000 x1. Now in 2000 x2, it's 900 over 1,000, and we see that's 90%. And in 2003, again, we put it over the base year. So we would put 800 divided by 1,000. So we're able to see how the changes occur compared to the base year. So our base year is 100%. The next year, our cash went down to 90% of the base year. The next year, 80% of the next year. And so we're able to see what's changing and by how much it's changing from year to year. Which of our assets are increasing, which are decreasing. How are our obligations changing? Our accounts payable are going up, right? We see that from 100% in 2000 x1, and then in 2000 x3, we have 120% of the first year. So that's obviously a 20% increase in our accounts payable. When we do the same thing for the income statement, we're also able to see how things are changing. We can see how our gross profit has changed over time. We can see it's decreasing, I should say, over time from x1 to x2 to x3. 2000 x3 is 74% of the base year. The base year, remember, is the earliest year. 2000 x2 would be 9,500 divided by 10,000. And then when we do 2000 x3, we would do again 9,300 divided by the base year. So everything over that base year. So to wrap up the trend analysis, when we compare multiple years by the base year, what we're doing is we're getting a feel for what's changing.